In this video, I am going to be showing you a simple strategy of trading RSI divergences on a multi-time frame. Now, I know I have made a couple of videos on the subject of divergence, but in this video, we will use a powerful multi-time frame analysis method to achieve high risk-reward trades. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, let us understand divergences. If you want to learn divergences in detail, watch my earlier videos. I will leave a link down in the description below. But just to recap, divergences occur when there is a contradiction between the indicator and the price. Now, divergences can be spotted on many different indicators. But I always like to spot divergences on the RSI indicator. Divergences are of two types, a bullish divergence and a bearish divergence. A bullish divergence occurs when the price makes a lower low and the RSI makes a higher low. For instance, look at this chart. Here, we see that the price made a down move and created this low. Then it went for a pullback. And finally it made a new low. The new low was lower than the previous low. But if we look at the RSI, it tells us a different story. On the RSI, the first low was marked here. And the second low was marked here. If we compare the lows on the RSI, we can see that the RSI makes a higher low. Therefore, there is a divergence. The price has made a lower low, while the RSI has made a higher low. This indicates that the momentum on the recent down move was lesser compared to the previous down move. The loss of momentum means the price might be ready to reverse on the upside. So we will look to buy on a bullish divergence. Now, let's look at a bearish divergence. So, here on this chart, we see that the price made this huge up move and plotted this high. Then, we see a shallow pullback in price. Next, the price makes another up move. This time, it breaks the previous high and registers a higher high. Therefore, we can say that the price has made a higher high. But the RSI tells us a different story. On the RSI, we can see that this high was marked on this point. Then, the subsequent high was marked at this point. Now on the RSI, we can see that the second high is lower than the previous high. Hence, we can say that the price made a higher high, but the RSI made a lower high. This shows us that the up move may have lost its momentum. Therefore, we should be looking for selling opportunities. A bearish divergence signals a possible downtrend. So this was a recap of the divergence. Now the problem is, every divergence does not work. For instance, look at this chart. Here we noticed a beautiful bullish divergence. The price made a lower low, but the RSI made a higher low. Therefore, this was a valid bullish divergence. So we expected the price to go up. But the price did not rise. Instead, it just continued the down move. So, whenever we spot a divergence, we cannot simply pull the trigger. We need to see the evidence for a reversal. For that, we will go on a lower time frame. Let's take a pause here and understand the time frames that we will use. For long-term investing, you can use a weekly time frame to identify divergences, and you can use the daily charts for your entry. If you are a swing trader, then I suggest using the daily charts to identify divergences, and use the 1-hour charts for entry. And lastly, if you are a day trader, then you can use a 1-hour chart to identify divergences, and you can use 15 minutes or 5 minutes charts for entry. Now that we have understood the time frames, let's continue the strategy. For our entry, we will simply look at the lower time frame and look for a break above or below the 50-period EMA. Let us understand the entry with an example. So look at this chart. Here we have the Euro USD on the 1-hour chart. We see that the price created this swing high, and then it pulls back to create this consolidation. Finally, it breaks the consolidation and makes a higher high. At this point, we know that the price has made a higher high. But if we look at the RSI, we can see that it has made a lower high. So this was a valid bearish divergence. Therefore, we want to look for a selling opportunity. So we will now switch to a lower time frame. Since we were trading on the 1-hour time frame, we will switch to the 15 minutes chart for the lower time frame. On the 15-minute time frame, we want to plot the 50-period EMA. Here is the same divergence that we spotted on the higher time frame. Now, for our entry, we simply want the price to break below the 50 EMA. When the price breaks above or below the 50 EMA, it acts as a confirmation of a successful trend reversal. On this candle, the price successfully closes below the 50 EMA. So we will place a sell order below the low of the breakout candle. We will place our stop loss above the breakout candle. One of the biggest advantages of the strategy is that the stop loss is very small. Therefore, we can aim for a high risk-reward ratio. What I like to do is, I exit half of my position at 1:1.5 risk-reward ratio. And I exit the remainder of my position on 1:2 risk-reward ratio. So, going on a lower time frame can help you with two things. Number 1, keeping a small stop loss. And number 2, achieving high risk-reward trades. Now let's look at a buy trade. Here we have the Euro-USD pair on the daily charts. Here we can see that the price made a down move here and created this swing low. Then we see a shallow pullback before the price makes a second down move. Now, the second down move created a low that was lower than the previous swing low. So, we have a lower low on the price chart. But on the RSI, things are different. The RSI has made a higher low. So this is a valid bullish divergence. Once we spot a divergence, we will now switch to the lower time frame, which is the 1-hour chart. On the 1-hour chart, we plot the 50-period EMA and wait for the price to break above the EMA. On this candle, the price breaks above the 50 EMA, and we enter a buy trade on this candle. We can keep our stop loss below the breakout candle, and we can target 1:1.5 or 1:2 risk-reward ratio. On some trades, I will even trail my stop loss to the 50 EMA. In other words, I do not exit my positions until the price fully closes below the 50 EMA. While on other trades, I just exit at 1:1.5 risk-reward ratio. It all depends on the strength and weakness of the price move. For beginners, I would suggest you start with a 1.5 reward target and raise the risk-reward ratio as you gain more experience. That brings us to the end of this video. If you liked this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.